Hey everyone, in this tutorial we're talking about capital raisings, what they are, why they happen, and some of the things that you can look for, as well as I might give a bit of my own opinion on perhaps what are the best ways for companies to structure these or what's the fairest way that they should be doing these. Just remember that this is general information and you'll find all of the details in something called an offer document or an information booklet. Typically that will be sent to you and it'll include things like how to apply, the exact details, the prices of the capital raising, etc. If you don't receive this and you're a shareholder and you believe you're eligible, you may be able to find more information by going to your brokers, your share broker's website, the ASX website, finding the company and searching the announcements tab. But they should send it to you. Otherwise you can contact your share registry for more information. Okay, so firstly, what is a capital raising and why do they do it? To understand it, let's put ourselves in the shoes of a company and a company owner. Let's say you have a company and you want to make an acquisition, so you want to buy another business, but you need money. You don't have enough money in the bank to go and buy that company. So typically, there are two ways we could do that. The first way is you could go to the bank and you could say, hey, give me some debt. I'm going to use that loan to then go and buy the company. The other way, which is common for companies on the share market, is to sell more shares in their company to new investors. And then they use that money that they collect from those shares to go and buy the company. Bigger acquisitions or bigger takeovers typically involve both the equity or the shares and the debt. We'll quickly focus on just the equity side of the equation. If you want to learn more about debt financing, you can go to our website and find more information there. So that's the what and the why. So let's talk about a trading halt, because when companies in Australia complete or undertake a capital raising, they'll typically be in what's called a trading halt. So that simply means that the shares in the company cannot be traded. So if you own shares and you had planned to sell by logging into your brokerage account and hitting the sell button, you won't be able to do that. The reason that shares are frozen or in a trading halt is because the company is attempting to do something material and it cannot release more information until it knows for certain the outcome or what it is planning to do. So you couldn't have, for example, a company out there issuing shares and shareholders then trading and not being informed about what is actually going on. So they halt the shares and they'll typically say in their announcement for how long they're going to halt the shares. It might be a day or two or maybe 3 or 4. A trading halt is typically undertaken and then an institutional capital raising is done. I'll get to that in just a moment, but typically you'll have a trading halt, an institutional raising, then trading will resume, and then you'll have the retail component. But I'll get to that in just a moment. Firstly, discounts. Why are shares offered for less than the market price? So you might go into your brokerage account and see that the last share price of the company that you own was $10 and the new shares are being sold for $9 or $9.50. The reason is that the company that's issuing the shares needs to sell them for a discount to entice buyers, to entice new investors. Because why would they buy shares at $10 when they can, from you now, when they can just go on the market or into their brokerage account and buy it from there? So they're typically offered at a slight discount. Now that's okay. Well, in my opinion, that's okay, but only if they offer the shares to everyone, which I'll get to in just a minute. So that's why they offer it. That's why they're at a discount. So you'll often see this word entitlement or entitlements in an offer document or in the ASX announcements. Entitlement means that you as a shareholder may be eligible or entitled to get some new shares or buy some new shares as part of the capital raising. So they might say you can buy 1 new share for every 10 that you own. So if you have 1,000 shares, you might get, say, 100. That was some good maths there. So that might be, say, a 1 for 10. You'll see that thrown around in numbers, and it might be a bit confusing, but just refer to the offer document and it'll have the exact details. And you'll also see, if you get that sent to you, it may also tell you who is eligible for the entitlement. Okay, institutional only. I just mentioned this. Institutional only capital raisings are done because they are cheaper. So let's say we have our company again and we want to raise some money from new investors. Instead of going to each and every little shareholder, what the company can do is just go to the biggest shareholders and say, hey, I need $10 million, for example. And then a big shareholder will go, I've got $10 million, here you go. Now, that might sound reasonable because it's cheaper for the company, right? It's easy for them to do. But it may also be unfair because the little shareholder, even though he or she may only have $500 or $1,000 or $10,000 in the company, he shouldn't be disadvantaged just because he's small, right? But what some companies do is they ignore the smaller shareholders because it's too expensive to organize, to have everything sent out, to get lawyers to look over all the details, etc. But what companies will often do is sort of a middle ground is they'll do an institutional capital raising, and then they'll do something which is called a share purchase plan, or SPP. And that's sort of like, we get the most money from the big institutional investors, and then here's a little bit for all of the little shareholders. And there'll be more details of that in the offer document. So the next thing is understanding what does the word retail mean? Retail is pretty much the opposite of an institutional investor or sophisticated investor. So a retail investor is someone that just has a small amount of money, isn't a professional, and they're just an average shareholder, a mum and dad shareholder, an individual that wants to partake in a capital raising. So they may do what's called a retail offering. So that's where most of us would fall into. The next word that you need to understand is underwritten or underwriting. So underwritten simply means that when the company is issuing these new shares, another company, like a big fund manager or institution, will say if anyone doesn't buy the shares, so if any of these people that are entitled do not want to buy the shares in the company, we'll buy them for you. So that might be a big financial institution, a big fund manager, a big share broker that has clients that would be willing to buy the shares, and they say, we'll underwrite it for you. We'll buy the shares if no one else does. Finally, renounceable. So you'll have this word written in some capital raising documents, but you also have the word unrenounceable. And renounceable simply means that you are entitled to something. So they'll say you can buy one new share for every 10 that you have, but if you don't have the money or you don't want to buy them, you can renounce your shares or your entitlement. So meaning that you can say, hey, I'm eligible to buy something. I know it's worth something, this entitlement that I have to this new share, but who's willing to buy it from me? I'm not willing to buy it, but someone else might. And there's some value there. So good capital raisings in Australia have a renounceable element. So smaller shareholders who perhaps can't afford to take up all of their entitlements should be able to trade away their entitlements. So for example, let's just have a hypothetical and say a share price is $10. A renounceable right, an entitlement, might be worth say 20 or 30 cents. It might not seem like much, but when you've got thousands of shares, it could be a considerable amount. Some companies who, in my opinion, have more integrity than those that just do it otherwise, some companies will allow you to trade these entitlements or these rights on the share market. So they might say, here's 3 weeks for you to trade away your right. And for you as a small shareholder, yes, it might only be a small amount of money, but at the same time, you can realize some value from being a loyal shareholder. So that's why, in my opinion, the fairest type of capital raising in Australia is one that is renounceable and it includes retail investors. Now, I understand that it is cheaper to do it the other way. So if there is a genuine reason why an institutional only capital raising is appropriate, then by all means, but it has to be well justified. Otherwise, loyal shareholders should be rewarded for their loyalty. I'm Owen Raskovich from Rask Finance. If you want to see more videos like this, please head to the Rask Finance website.